Hey guys, thank you so much for joining us. Welcome to Blockchain Banter. I'm Jen, I'm your host. I'm here with PrimalGlenn, BD at Bancor, and Mark Richardson, project lead at Bancor. We haven't done one in a while, so it feels good to be back up here and to have you guys with me. So thank you so much for joining me.
Pleasure.
Glenn, I'm
Thank
gonna,
you.
yeah, of course. So should token projects be their own on-chain market maker? We've spoken about market making a little bit previously, but we've never really addressed this topic specifically. And the reason I wanted to was, Glenn, you had posted something last week that really caught my attention. And I think it is something that is being discussed quite thoroughly, or dissected maybe might be a better word, right? This sort of activity is being dissected right now. And I would normally share it, but I don't want to name names and put anybody on the spot, different projects and things. So maybe without doing that, maybe you can fill the audience in, what post I'm talking about, fill them in on what had actually occurred, right? And kind of the outcome of that. And then we'll go from there.
Yeah, I think I can start. I'll give you a little bit of background on that tweet that I put out last week. But essentially, it's a brand new project, right? They don't have a token yet, but obviously the token has some functionality in their protocol, right? Part of their process of essentially having this token out there is, as they're launching it, they do their TGE, right? Their token generation event. They want to get this thing listed on a few trading venues, right? A few different centralized trading venues. And one of the things that they actually put out there or revealed to the community was that some of these centralized trading venues, right, they asked for a large percentage of their token supply, right? And I think for this project specifically, it was somewhere between like 8 to 10% of their token supply needed to go to a centralized trading venue in order to be listed there when they did the token generation event. So from day one, right? So that's quite high, I would say, in my opinion, right? And this was also in addition to also having to pay certain fees, right, to the centralized trading venue. And there's also other costs, right, because these projects are also at that point in time, they might need to have like a market maker on a retainer, or they might have to do some sort of like a model where they're loaning tokens to a market maker, right? And those can be structured in multiple different ways, right? We're not going to discuss what those are, but in general, a lot of people were saying that, okay, this is like quite predatory when it comes to what these different Texas are asking of projects just to get a listing, right? So what this project had done was, okay, they had essentially, I think, forgone that listing, right? And then they decided that, okay, they're going to launch the token, which they did. And then they decided to do on-chain liquidity, right? And when they did their on-chain liquidity, right, a lot of people were questioning what their actual strategy was, because the wallets that they had publicly put out there, right, they just saw these wallets selling, right? And if they were sort of market making, you would expect buying to be occurring as well, right? And no one quite knows what exactly their strategy was, because this wasn't something that was revealed to the community. But people in certain groups, right, they were talking about this offline. One of these, it's Lobstered Out, right? They're quite known. There's a large Telegram group. They're talking about the different strategies that projects can actually take when it comes to doing on-chain market making. And one of these is potentially, right, you have a governance token, right, which you need to somehow utilize in order to fund your operations, right? And you also want to provide liquidity. So what you can do is potentially take this governance token, put it for sale, right, at some price point or within a range, right? And then whatever proceeds you acquire from this token, right, you essentially can use that to buy back, right, that same token at a lower price point or at a range, right? And essentially this process, right, it's quite complicated one to achieve on chain, because DEXs were not built with this in mind, right? Trying to do this on chain, it's quite complicated. We can talk about that in a little bit. And then the other thing is also potentially if you want to do this on chain, you want to do it transparently so your community is actually seeing this, right? And I believe a lot of the criticism this project received was part of that. Part of that was the reason that it wasn't done in a transparent manner. Like people didn't know what they were doing on chain, right? And it's just because they couldn't actually see, right? So essentially, I think if you do this transparently, right, your community might actually understand what's happening, and you might not get so much backlash. And this is essentially where like carbon DeFi comes into the picture, right?
Okay, so I'm going to stop you before we get into carbon DeFi. Before we get into some of these different things, I want to backtrack.
Sure.
Mark, I don't know if you recall, we had a call with a market maker at one point, and I know you've done some panels and met with quite a few, right? Leading Bancor and having carbon DeFi, but just spoken with market makers, even since the beginning, of Bancor. I think Bancor just posted something with, Eyal Herzog, the co-founder, at a recent conference speaking about the early discussions with market makers, saying, just like Glenn had said, that the AMM, that DEXs weren't made for this sort of activity, right? But it was a Blockchain Banter also that we had a market maker on with us, and they were basically saying that your on-chain activity is almost like your audition, like your resume for a listing on a centralized exchange. Maybe you would know, like 8 to 10%, the cost of going on a centralized exchange, the market maker. This is all, as far as like to the best of your knowledge, this is pretty standard, because that seems like a big initial obstacle to get over when you're first launching a token.
I wouldn't say that I have a large enough sample size to know what is standard. And, Bancor hasn't entered into any of these agreements. So at least from our perspective, we have zero experience dealing with these kinds of agreements. But, within my network, there are a lot of people that have had to go through this kind of process. I would say that this one it seems a little on the high side, but certainly not out of the realm of what's ordinary. But we should categorize that, because I think with this specific case, it is unusual to have to hand over a very large amount of your actual token supply to the exchange. Usually, what occurs is you have to enter into some agreement with a market maker, and they usually do take a fairly large percentage of the token supply, but under a very specific contract where there will be basically an option price attached to that token supply. And this is to incentivize the market maker to actually do a good job, and to disincentivize them from, let's say, misusing the tokens that you give them. So it's about, let's say, alignment between the project that actually has the tokens and requires those markets and the person who's going to be responsible for producing those markets. To hand them over to the exchange directly is, I think in this case, a quirk of the fact that a lot of these centralized exchanges are also the market makers or the predominant market makers on those exchanges. Again, we don't want to single any particular business out, but it is one of the things that's unusual about cryptocurrency centralized exchanges compared to something like the NASDAQ, right, or the NYSE or the CME, where if you're trading in securities, there's like a deliberate distinction between the people that are running the exchange and the people who are clearing orders and making markets. Whereas in cryptocurrency, all of those things happen at the same time by the same people. So I think in this case, the fact that they're asking for 8 to 10% of the token supply or something is probably because that specific exchange was planning to operate as a market maker with those tokens, in which case it's not too unusual. But I would have thought it would be an either or, right? So either you provide tokens for the explicit purpose of market making under a certain contractual agreement about how they will be used, or you pay, a listing fee and so on. It seems like the exchange is double dipping, trying to get both of these things. And if there was no agreement or, proviso on how the tokens were going to be used, then it seems a little bit exploitative. I wouldn't have made that deal, and it seems like this project didn't either. So yeah, it's par for the course, but maybe a little bit more predatory than usual.
Are you guys seeing more, like, I know I am. I think we've all more or less been around for the last 5-6 years. But do you remember when it was a really, really big deal if your token was listed on a centralized exchange? I'm not seeing so much of that anymore. Do you guys see much of that anymore? I'm seeing more and more projects actually kind of leaning more towards on-chain, but it could just be me. I'm curious what you guys are seeing.
I think that it lingers on. I think that having your token on something like Coinbase or Binance or MEXC or OKX, it lends some credence, to the validity of that token. And certainly the trading volumes, washed or not, are much, are generally much higher.
If you have that market maker though, right, Mark?
Well, yeah, like I said, but sometimes the exchange itself is going to do that market making.
Yeah.
So yeah, if you haven't specifically employed a market maker to do it, sometimes the exchange will employ themselves as a market maker for a specific token. So for example, Bitcoin, isn't an organization. It doesn't employ market makers. That's something that decentralized exchanges do, either for the purpose of maintaining a healthy market, to attract speculators to that specific market, or standalone market makers will do it out of their own volition because the trading volumes on Bitcoin are so high. But it's I guess that's kind of besides the point. But I think that for projects in their communities, it is often perceived as an upgrade. Like the market for that token has finally arrived now that it's available on a centralized venue. But I do think that excitement is misplaced in a lot of cases. It can often mean that the market for that token becomes a lot more opaque, whereas on-chain markets tend to be a little bit more reliable. And that's not to say that on-chain markets don't have their issues as well. They certainly do, but not nearly. It's a change of orders of magnitude and opacity compared to the centralized markets.
Right.
But I do see it. I think that mentality lingers on from the 2019 days and is persistent.
Glenn, this particular project, right, went with just forget the centralized exchanges. We're doing our TGE. And we're doing it all on chain, right?
Yeah, so like they did go on chain, right?
They just bypassed all of the centralized exchange stuff.
Yeah, as far as I know, they when their TGE was all on chain, right? And I'm not sure what happened afterwards, if they actually went to a few sexes. But like one of the things that Mark mentioned, right? Like typically when you get your project on the sex, right, you do have like a listing fee that you have to pay. But a lot of the times now with these exchanges, right, they have a lot of them have their own wallets, right? They also have their own tokens. And what they tend to do is like, okay, for our token holders, right, if you have this thing stake in our platform, you will get access to new tokens that are launched on our sex, right? So this is where they sort of tend to, I would say, push some of the smaller projects to not only like pay a listing fee, but also give them some of their token supply. Because then what they do is they distribute this back to some of their token holders. They sometimes do these things with their wallets where, okay, you might have some sort of like a quest type of thing, right? Or they might have some sort of like a launch pad type of thing where if you have this token, you can stake it to get more of it, right? And this comes
Right.
directly from the project, right? So that's not necessarily, I would say, a hard requirement with certain sexes, but I think they do tend to push a lot of the small projects to actually do this in order to
I think it's almost like liquidity mining rewards in a sense, right? Like you're paying a
Yes.
fee and you're turning around and you're participating, whether you like it or not, in some sort of liquidity mining. And using your token as that reward.
And this might not even go to your token holders themselves, right? This goes to like token holders of the actual sex token itself, right? Because they're trying to get utility for their sex token, and this is like one of the things that they do. They ask these.
That's like a worse fee,
right?
Okay, I'm sorry, Glenn. Go ahead, finish your thought. I'm sorry.
Yeah, so that is like, I would say, like what has sort of like these listings have morphed into, right? It's not just like a fee anymore. You have these other things as well that they want you to do, right? And I think sometimes you don't do it, right? It's sort of like, okay, they might not prioritize your listing, or they might just like give you like a high listing fee, right, as compared to what the normal amount should be, right? So yeah, this project specifically, when they did their TGE, I'm pretty sure I saw that it was all done on chain, right? And yeah, they just went with like, obviously the traditional, constant product liquidity, right? But then they were also trying to quote unquote market make for their own token, right? And this is where I think things got kind of complex. And also their community got quite upset because some of that activity that they were seeing from these wallets was kind of unexplained, right? The project wasn't explaining what was actually occurring, right? Why there was so much selling happening without any buying at all, right? So,
okay.
Yeah.
So let's do this. So like the question here is, should token projects be their own on-chain market maker, right? I mean, they can't necessarily be their own like centralized exchange market maker, right? Like traditional market maker can, but can't, right?
Right.
A little bit more difficult, not to mention the actual token listing. So we're talking around 8 to 10% of the token supply, the actual cost of having your token listed. And then if you like the exchange itself isn't acting as the market maker, now you're also employing a market maker to actually make that market, right? There's more than just having your token available is market making. And with the market maker that we previously had on, they were saying that they're very hesitant to take on new tokens on centralized exchanges because they lack that on-chain data and that proof of actual activity. So they're very cautious with who they actually decide to do business with or take on as clients, because they want to do this in a solid, honest way, right? With a little bit of history of how this token is trading. So it seems like it's just a complex, sort of costly process to do this, especially if you're a newer project, if you're not very well established. So I think, should token projects be their own on-chain market maker, considering the alternative might be so out of reach for some, they might want to be, right? It's just a matter of how. And this is what you were just explaining. The main criticism was how this was actually done on chain, with that lack of transparency, right? So now you said that they were using a constant product automated market maker. This is kind of your standard AMM, right? Mark, this was the first of Bancors, right? This is your standard 50-50. It's 0 to infinity. There's really nothing much that you need to do.
Yeah, correct. I mean, yes. So the very first liquidity pool on Bancor was between BNT and GNO. And it was what's called a 50-50 weights liquidity pool, which is the X times Y equals K algorithm. But you don't have to choose those specific weights. You can vary the weights so long as they both sum to 1, right? Or we call these the normalized weights. Yeah, but yes, the X times Y equals K algorithm is the first.
I'm sorry, question for you then. So I'm a new token project, right? I have my token. I want to make it available. I'm going to make my market on chain. I don't have, I mean, if I don't provide a lot of my token, it's going to be spread so thin that there's really not going to be much liquidity available at any price point, right? In order to supply sufficient, a sufficient amount of my token, I need to also have that balanced with a stable coin or ETH or, you know, another token that I'm going to be pairing it with, right?
Correct.
So I have to have that kind of to take into consideration. If I want $50,000 of my token available, I have to have $50,000 of this other token to balance it out with in order to make my own market on a constant product AMM. Is that right?
Yeah, depending on the weight settings. If the weight settings are 1-to-1, then yes, you'll need to have an equal value in both of those tokens. But the
So
irony
there's a
is,
significant cost, or there can be associated with that as well. Go ahead.
yeah, and it's also needless because, you know, at the time that a token is you know, how it is becoming available, right, for the first time. So in that moment, there's really, you know, the project that holds all of the tokens, and that's basically it, right? You can say that, you know, they might have seed investors or something else. Let's just put all of those people in one category and say that, you know, everyone involved with the token project up until it's launched or prior to it being received by the outside world. So at that moment in time, you can create a constant product liquidity pool and put in, let's say, as you said, $50,000 worth of something like a stable coin, and then, you know, $50,000 worth of the other token. And, you know, that can give you instantly a market cap as high as you want, depending on the token supply. So if you want to become a $1 trillion market cap token, it's very easy to do because you set the price and the token supply. Whatever decision you make there, the USDC that's in that pool will never be touched ever because no one has the token. And so if you put $50,000 worth of USDC in that pool, it's really just symbolic because it can never be accessed by anyone except the project themselves. So sure, like if one of the, you know, if there was a rogue developer or something, you know, inside the organization that decided that they were going to figure out how to unlock their tokens early and dump it all into that liquidity pool, whatever, which happens, I'm still categorizing that as belonging to that, you know, group of individuals. So that's really just the project buying token, like, you know, buying USDC with the tokens they have from themselves. So it's meaningless, right? You could have just started the liquidity pool with slightly less USDC and slightly more of the token. It wouldn't have any material impact on the results of you know, its interaction with the outside world. Now let's say that the token project doesn't do that, and that the lockups and everything else are relatively well maintained. Then the only thing that the outside world can do is buy tokens from that pool. So let's say the first dollar, you know, of trading activity comes in, by definition, it has to be someone buying the token because no one has any tokens to sell. And so that means that the USDC balance or whatever is going to go up by 1. And now there is only $1, right, of bidding liquidity underneath it, because as we've just proved, the first 50,000 is completely symbolic, may as well not be there. And this means that first $50,000 can probably be put to better use, seeing as it doesn't actually serve any purpose at all inside that liquidity pool. And so for this is where solutions like concentrated liquidity are super useful, because you don't need to provide that USDC. You can just provide the token, and you can provide it in a, you know, strict overlapping sense, such that the mechanics play out exactly the same way that they would have. So you can still have, if you want to, you know, a supply of.
Can you actually supply? Okay, you're saying that you can do it with a single token, right? So, Glenn, I'm going to throw this one back at you because I think this was part of your actual post, right? somebody was
Yeah.
saying they wish there was a way that they could have done this. So
Right.
what allows you as a maker to provide a single token using concentrated liquidity versus the two, right? Being
Right.
obligated to provide both.
So in concentrated liquidity solutions, right, you can do something like an out of the money liquidity position, right?
Which sounds like it should be self-explanatory, but what exactly does out of the money mean? Not
right. So when you're the project, you get to decide like what the price is of something, right? So if you're trying to sell a token at $1, right, you can just configure the pool to say that's the price, right, and then you just supply the single token starting at like 1 and above, right?
okay.
So this way you only have to contribute 1 token, right?
So you're not providing your liquidity or your tokens at the current market price.
Right, you're not providing it, for example, some percentage above and below the current market price, in which case you have to provide both tokens, right? If you're just providing the token a percentage above the market price, you only provide a single token. And it's the same in the opposite direction, right? If you're providing, if you're buying something below the market price, you only have to provide a single token, right? Only when you're plus or minus some percentage from the current market price, then you have to provide both tokens, right? And then the ratio could change between these two things, because you might say, I'm going to be, plus 10% above the market above the market price and minus 5% on the other side, right? In which case you're providing more tokens to one side than the other. It's not evenly distributed between both.
Okay,
right?
So there is then, so with what you're saying and what Mark was starting to say, a token project, or anybody for that matter, right? As long as you're providing liquidity in this sense, or you're putting your tokens up for sale, or, making an offer to buy something, you are making the market. You are essentially acting as a market maker in a way, right?
Right. In a way you are. And then obviously all of this happens on chain, which is at that point in time, it's automated, right? So you set this up.
I think that was the lack of something, right, Glenn? In your post, there was, I wish there was a way to do the single-sided, but then have something automated.
Right. So
right? What was the difficulty there? What was the challenge?
Absolutely. So the challenge then becomes, right, as you're trying to do these things on chain, right? Let's say you're the project, you have the token supply, you want to sell this token for something else. Let's say token X, you want to sell this for some USD stablecoin, right? So as this token is being sold, right, those proceeds, you might want to do something else with those proceeds, right? For example, you might want to take the proceeds, right, and put a portion of these proceeds to buy back the token at a lower price point, right? So the
this
people
is the actual market making. You're selling,
right.
You're rebuying, you're making both sides available, right? You can act as a market maker, make the market, and provide your token. But this is where that lack of transparency they might have been criticized for this, because without that, it appeared as if they were strictly selling.
Yeah, without that, it appears that they're strictly selling, and you don't necessarily know what the proceeds of selling, where that's going, right? And then keep in mind, right, that if you're doing or trying to do such a, you're trying to do such an operation on chain on your traditional DEXs, right, your prototypical AMMs, right, you really cannot have a buy order and a sell order that it's not overlapping, right, where you're selling at some price point and then buying back at a different price point, right? Like these things.
Okay, so you went to orders. We were talking like concentrated liquidity and things like that, right? Really quickly, when you're providing one token out of the money, and Mark, please jump in here also, because I know that you were saying that market making is a lot more difficult, or can be a lot more difficult than what I think a lot of people really realize. So this is kind of why I want to ask you guys, you provide your one token out of the money, right? It appears as if you're strictly selling. There's no way to automatically really buy this back on a traditional AMM. And this was the big criticism that AL was talking about recently when creating the AMM, was that traditional market makers were saying this is just too simple. Like there's not enough for us to be able to do, or, you know, when we need to create an actual market, right? So what happens if you provide that one single token and then somebody buys it? Where does that USDT go? What happens when the market starts to shift and you're suddenly in the money? What happens then?
So the way the
Glenn, I'm going to come back to the orders. I want to kind of close up this loop on the difficulties, like the what's challenging with the concentrated liquidity. So excuse me for a minute. Mark, go ahead.
Sure. So the original AMM paradigm didn't really change very much when it moved over to amplified or concentrated liquidity paradigms. And the difference was that instead of being forced to enumerate your price tranches from 0 to infinity, you now get to use a finite subset of that. So a specific interval of prices, like let's say $5 to $10 or something like that. But as prices are taken, right? So let's say that you've got some new token and you provide, you know, its price is currently at $5. So you provide liquidity from $5 to $10. So you're still out of the money. As the price moves up, then you're going to be selling those tokens for whatever the chosen numeraire is, let's say USDC. But those USDCs are put immediately behind the price that it was purchased from you at, minus a very small delta that's called the fee, which I always hate that term, but that's the one that the industry uses. Okay, so what does that mean? That means that it's still automatically market making, but it's doing so using a prescribed algorithm, which is that the price that you sell something for, you must then offer to buy back the same quantity at the same price that it was purchased from you at. So all of your asks, as they're taken, are flipped to corresponding bids with the same unit size. So if you sell any number of tokens between $5 and $10, you must then offer to buy back the same number of tokens at the same effective rate that you sold them for, minus that small delta. So you could sell $1 million worth of token and then be forced to buy back $1 million worth of token and only make 0.01% or whatever the fee tier is on the pool. Now that's a very prescriptive trading algorithm that does service, I would say, consumers very well, right? So in terms of prioritizing certain sections of the market, this was the view adopted by AMMs because it is a good, healthy way for the market to operate. It's kind of predictable. It's not prone to to sudden changes depending on liquidity depth and so on, but it's very smooth, right? And I think that that's probably the best way to say it. Now the problem there is that you have to remember that one of the criticisms that AMMs have received as it became a user-facing enterprise, right? As it became something, the assumption is that users themselves will provide liquidity to these things rather than projects, is that they're not very financially performant, right? The financial instrument that they represent is very, very low yielding, usually negative yielding. And market makers are businesses. And so they need to employ methods that keep their financial incentives positive, or they cannot afford, otherwise their business becomes unsustainable. Now, if the trading volume for a certain token is extremely high, right, and its price is relatively stable, so you could imagine something like ETH for a little while has been relatively stable at a certain price point. BTC is going sideways, that kind of thing. This is when market makers do very well, because anyone who comes to buy Bitcoin from them, they're happy to sell it, knowing full well that there'll be someone else back in the queue that's going to sell them the Bitcoin back, and all they have to do is effectively clear that difference in the in the spread, and that's where their profit margin comes from. So if all tokens obeyed that kind of trading mechanic, so they all had that market microstructure, then an AMM would be a totally reasonable way to do things. But as soon as that assumption becomes bad, and the token price starts trending in either direction, so like when BTC is on a move up for long periods of time, market makers get very shy about making markets for it, because if someone's coming in and buying BTC from you today, you have no idea if that BTC is going to be worth 50% more or something next week. And so liquidity tends to thin out. With AMMs, you don't get the flexibility to redistribute your liquidity according to your evolving expectations of where the market is headed. The AMM is in some way very very stagnant. It's very very deeply entrenched, very immovable. That doesn't allow market makers to employ these kinds of risk mitigation strategies that they would use in a conventional context. And this is for two important reasons. One is that especially the more sophisticated market makers are using sort of real-time risk adjustment algorithms to move their core prices around for them. And this requires very frequent updates to the prices that they're quoting. And if you were to do that on a blockchain, it would become prohibitively expensive very quickly, just because of the gas consumption associated with making all of those transactions. And then the second one is that the infrastructure itself is limiting. So even though there are things that are even with the concentrated liquidity paradigm, even though you can do things like choose a specific price point and that kind of thing, which is very good, the fact that if your asking liquidity is taken, that it immediately and automatically converts to bidding liquidity behind that same price is a concession that most market makers would not be willing to make, specifically because it's not aligned with their risk mitigation profile.
Jen, you're muted. You're talking, but you're muted.
Well, it's not the first time I talked to myself today. Thank you, Glenn. And I didn't mean to cut you off earlier. I wanted to kind of really just dive into why this is so difficult for a token project. And like, if it's so difficult to get onto a centralized exchange, and it's difficult to achieve these sorts of things on chain with a decentralized exchange, then really what are their options, right? And this is where, Glenn, you were starting to say that somebody was saying they can provide this single-sided. They wish that this automation came into play. I know we have like about 15, 20 minutes left. I really want to focus on what the solutions for these token projects actually are now, right? Like your post kind of went into what someone suggested, what they wished they saw, and then what Bancor is offering through Carbon DeFi, its latest DEX. So Glenn, tell me a little bit more about your post, and then I want you guys to really just kind of just take it away for me.
Yeah, so like I guess the solution, right? It's complicated, right? Because as Mark was saying, right, as your asks are being taken, right, this is being transformed into bidding liquidity, right? So you have this, essentially you have a bid-ask spread that is moving around, right? So if you're a project, you want to sell your token for, let's say, USDC or for some other token or for something else, right? And if you want to, for example, withdraw that liquidity so that as your tokens are being sold, you get to keep some of these profits, right? And then use the profits to buy back your token at a lower price point, then you're looking at potentially having some sort of like a keeper that's watching your position, and then withdrawing the liquidity as it's getting filled, right? Because if the price retraces, then what you just did gets undone, right? Because your asks are being taken, right? This thing it's essentially moving over to your bidding side at the moment, right? So that is complexity, right? You have a keeper that's watching your position, and then it's withdrawing your liquidity, right? And then what you also have to do is now you have to set up another, let's say, another concentrated liquidity position, right, with the proceeds, right, that is being used to buy back your token at a lower price point, right? And if you imagine what that looks like, it's essentially having some sort of automation, right, that's withdrawing liquidity from one concentrated liquidity position, the one that's selling your token, right, and then putting this into another concentrated liquidity position, right? And this thing has to be monitored 24/7, right? The keepers have to watch your positions, withdraw liquidity so that if things retrace, they don't get undone, right? So it's quite complex and complicated to have to do this on chain using your prototypical concentrated liquidity solutions, right?
You're
And
also
then,
introducing a little bit of additional third-party risk, right?
right,
Because you're
you have
relying on a keeper and you're paying that fee, right?
right,
Keepers
you have
have their
a
own fee
third
as
party
well.
info. Exactly. You're introducing some third party infrastructure, right? And then there's fees involved that you have to like potentially provide to this like bot to withdraw your liquidity, right? Do some automation, right? And a lot of the times, like when you might actually need this to happen, right? You might be fighting against other transactions on chain that are also trying to do something important, in which case you might not even get included in the next block, right? And you might miss this opportunity because by the time it does get included, right, well, maybe by that point it's too late and your transaction just reverts, right? So there's all these complexities. So this is where Carbon DeFi comes into the picture, right? And it does help with these types of strategies that projects might be looking to do, right? Not
I'm
just
going to bring your screen up on stage. I'm going to display this. I see that you're sharing it. Can I bring it up?
Yeah, you can bring my screen here. Right
Okay.
now, I am on the say instance of Carbon DeFi, right? To use this as an example, because I do happen to have some tokens here, but you can generally use Carbon DeFi on Ethereum. It's on Celo, it's on TAC, it's on CoTV2, obviously on Say, and then we also have a few other licensees set up licenses protocol, and they have taken it to other blockchains like Base. So it's available in a few different blockchains out there. Go to our website, you'll see it there where you can actually utilize the protocol. In this example, right, if you're a project,
Glenn, are you able to zoom in? Can you zoom in a little bit? Because we're going to go
yes.
through this
Let
piece
me
by
see.
piece. We've got the big picture,
One
right?
second.
But I don't think we necessarily need it right now if we just kind of go through these by step. So let's pretend I'm a token project.
Right. If you're a token project, you have a portion or a large portion of your token supply, right? Let's say this is, in this case, we're going to use Say as a token, but this can be your own ERC20 token.
Let's pretend I'm Say. Mm-hmm.
Right. And obviously, this other token here, we've chosen USDC, but this is like the numeraire or what you want in terms of proceeds, right? Which token do you want in terms of your proceeds, right? So this can be anything, right? Most projects will utilize something like stablecoins or something like ETH or BTC. This is what they want to use the numeraire token. This is what they want to use, right?
Glenn,
but we'll use USDC to make things simple.
I know Say was already on there. If this is the first time that a token project is going to be adding their token, it is permissionless. Carbon DeFi is permissionless, right? So they just add their contract, paste the contract in and add their token.
Type in the contract address here, right? If it's not listed here, you can type in the contract address. Some projects do reach out to us. They're like, oh, how do we actually have our token listed into like a list here? A lot of our deployments, they rely on a token list, which is made available by blockchains. And typically that's public. Anyone can contribute to that token list. Just submit a PR or a pull request. And then once it gets added to that token list, it will show up in Carbon DeFi, right? And we can help you with that. If you need to have your token listed on Carbon DeFi, we'll just point you to the correct token list.
Cool. Okay, so they're using their two tokens, right? We're pretending that I'm Say.
Right.
And I want to pair it with USDC.
Pair with USDC, right? This is what I want to maintain my proceeds in, or my what I'm selling my token for. It's going to be USDC, right? say can be the project's token, right? And this strategy where, okay, you want to make your token available for sale at some predetermined price point, right? As you're sort of thinking about making your token available on chain for people to buy it, you might have a price in mind, right? And obviously that's up to you to decide, right? But let's say that price might be, you want to make one token available for sale at, let's say, 0.37 cents here, or 0.37 USDC per one token, token X, which is your token, right? And this is what this looks like on the chart, right? And you might have a certain prerogative that if someone is going to sell your token back to you, right, you're going to be buying that token from the market at a lower price point. And this is where on Carbon DeFi, we let you determine this as well, right? Where you can have your sell order and your buy order, right? Essentially, these two things are distinct, but they're behind the scenes, they're essentially linked together. So if yeah.
So really quickly, so instead of we're talking about constant product, we're talking about concentrated liquidity. I know Carbon DeFi offers both of these. A little bit more benefit, I would say, with the auto compounding and things like that with Carbon DeFi, but a traditional sort of buy and sell within a single price range. What you're showing us right now is two separate price points. It's not the buying and selling happening within, like Mark was saying earlier, where if you sell a token, you're kind of obligated to buy it back at that same price, right? This isn't the case at all. So with this sort of strategy, you're saying these are linked together. That would essentially, this is why you were suggesting this would eliminate that sort of lack of transparency that this token project was facing with these criticisms, right?
Right, correct. In this case, unlike traditional IMMs, you're not forced to buy back your token at the same price that you sold, right? And this might be the strategy that a lot of these token projects might want to employ, right? And what we can do here, right? We've selected two separate price points, right? And we're only going to contribute our token, right? Because we might not have any USDC, right? And essentially what we want to do is contribute our token, some quantity. We're going to do 10 because this is what I have in my wallet, but this can be like any quantity of your token, right? And you're making this token available for sale, in this case at 0.37 USDC or 0.37 cents, right? And what happens behind the scenes, right? If we let's just do 10 here. So the math comes simple, right? If you sell 10 of these tokens at 0.37 cents, right, you're going to receive 3.70 USDC, right? This USDC that you receive then behind the scenes essentially rotates to the buy order, right? And that is now made available to buy back your tokens at a lower price point. Right. So this is where
are you obligated to provide anything for that buy order initially when you're creating this sort of position? Right.
You're not right.
Okay, go ahead. Go ahead.
Yeah, you're not obligated to fund the buy order. You can fund one order or you can fund both, right? It's totally up to you. Like a project might not have any USDC liquidity, in which case they might not necessarily want to fund the buy order, right? So what they're looking to do is have their token available for their community to purchase, and whatever proceeds from that activity be utilized to buy back their token at a low price point, right? So this is what Carbon DeFi lets you do. This happens transparently on chain because these orders are put on chain, right? So anyone can view that this is happening, right? And this is where I would say the solution truly shines, because you're no longer relying on an oracle or a keeper or some sort of like third-party infra and automation, right, to do this for you. This is built directly into the protocol, right? And it's there for you to utilize.
Glenn, a couple questions. So we chose an out of the money price point to start and only provided one single token. So it's a
Mhm.
little bit similar in that starting, that first step to the concentrated liquidity, like we were speaking about earlier, right? What if I wanted to set that sell order? If I wanted to make my token available right now at, the current market price, right? It's not necessarily the first time it's trading, but I need to make a market.
Sure.
Can I do that and still only provide one side of this particular strategy, this recurring strategy?
Yes. So you can still do that,
Still
right? Like,
single
um,
sided.
yeah, in this example right now, for this specific trading pair, this is the current market price, 0.194251, right? If you were to, for example, put your tokens for sale at the current market price, right, a portion of those tokens could actually be taken as soon as that order gets created, right? So there's no, we don't like dictate at what price you can actually put your tokens for sale at. Obviously, if you're going to put your token for sale below the market price, we'll definitely give you a warning, right? Because you're selling it below the market price. So that might be something you're not looking to do, or actually might be something that you're looking to do if you're looking to liquidate a large portion of tokens because you might have participated as an investor in something and you're trying to get rid of that position, right? In which case that might be like quite a valid a trading strategy, right? You're just looking to liquidate these things, and you can certainly do that, right? We'll just give you a warning that you're trying to sell something below the market price. But yeah, if you're a project, this is what Carbon DeFi lets you do. The other thing that I should mention here is you might not necessarily want to place your token for sale at a specific price point.
I was
right?
going to ask about this. I see range there on the app that you're showing us.
Yeah, absolutely. And range is, for example, you telling the market, right, the first unit of this token is going to be sold at some price. And that might be, let's say, 0.37 cents, right? And every unit of that token that's sold afterwards is going to be sold at a higher price, right? So with a range order, you get to decide, right, what is the starting sell price of your token and what is the ending sell price of the last token that you're going to be contributing, what that gets sold at, right? So for example, if I'm choosing a range here between 0.37 to 0.50, right, I'm going to contribute, let's say, these 10 tokens, right? What ends up happening is these 10 tokens, they get distributed, right, across this price range, right, which is 0.37 to 0.50, such that, right, if I were to sell all 10 tokens, right, then I'm going to receive 4.3011 USDC, right? This is where Carbon DeFi essentially lets you do these more, I would say, advanced buying and selling, orders, right? With utilizing ranges, right?
With
So that
a whole nother level of automation, right? Like it's not just the linked orders and the automated. So when really quickly, since I'm talking about this, you sell, like if I'm say, right, I sell my say, my USDC funds my buy order then, right?
yeah,
So if say goes back down, then I'm buying the say and using my USDC. Now, when I have that say, it automatically rotates to the sell order, and this just continuously happens. I don't
right.
have to do anything at that point?
Yep. No, you don't have to do anything at that point in time, right? If you're a project, what ends up happening at this point in time, this thing will trade forever, right? But you can always go back into this strategy and you might decide, okay, I've had a few cycles of buying low and selling high that have occurred, right? I might decide to maybe withdraw a certain amount of funding, or you might decide I'm going to add more funding to this strategy, right? You can certainly do that quite easily without having to like recreate this entire thing from scratch, right? The other thing that is a project that you can do, you can always come to the strategy itself and modify the actual prices, right? So if you decide maybe selling between 0.37 to 0.50, it's no longer something that I want to do. You can edit the strategy, right? And perhaps choose a different range, right? Where you want to essentially make those tokens available for sale. Right, so you get full flexibility when it comes to not only deciding where you're going to be selling, where you're going to be buying, right? Quantities that you're going to be making available, funding one or both orders, right? But also like being able to modify all these things after the fact, right?
Now, and is this transparent? Because that was one of the main criticisms that you had mentioned earlier of this one project that had attempted to do this or was being criticized for strictly selling, right? Is this transparent? I know it's all on chain. Theirs was as well, but can someone go in and see, or can the token project be like, look, hey, we're selling here, we want to rebuy here. This is where we're making our market. We really are doing our own market making.
Right, absolutely. It's transparent. Obviously, all Carbon DeFi orders, they get posted on chain. So that's like one way for you to actually view these strategies. And then from our UI itself, we have a way for you to actually view all the strategies that are available for a certain deployment, right? So you can always go here, right, and then view the strategies that are created. You can share a link to your strategy to with your community, right? And essentially what this looks like, if we just use this one as an example, right? This is what the strategy will look like if someone is viewing it through our UI, right? It tells you all the actions that have occurred, right? Buying, selling, any edits that you've done, right? Timestamps. It's all here for the actual community to actually, for the community to view, right? So this is where that transparency comes into play because these orders are put on chain. Right? If you're trying to do this via some other means or method, right, you might not get the same transparency as if you are using something like Carbon DeFi.
So many advantages to it. I'm glad that you guys were willing to come on and really explain this one, because I feel like we're seeing more and more of token projects actually attempting to do this, right, with the sort of restrictions that they have on centralized exchanges and listings and things. And I'm seeing, and I know we're at the top of the hour, I apologize if either of you guys have to drop, I'll make it super quick. I know that there are a couple of projects that are actually doing their own market making currently on Carbon DeFi. One of them we had, actually had a previous Blockchain Banter with, and that was Governor. So for a few different reasons, kind of similar to what you were saying, it wasn't so much into the difficulties of doing it, as the alternative on a traditional AMM. But I know that there are a few token projects that are actually doing this currently. So Glenn, what do you recommend, or Mark, if there are token projects that are looking to do this? We showed that it's permissionless. They could essentially do this themselves. I did share your X. Is that the best way for somebody to reach out and, really communicate with you guys and maybe get a better feel for Carbon DeFi and what they're able to achieve using the DEX versus maybe a traditional AMM? What do you suggest?
I think that the application interface is relatively self-explanatory if you have an idea of what your market structure should look like. There's also a simulator resource there that will help you understand, how profits result from the way that the market moves around. Again, like if you control the entire token supply, then that kind of attitude towards trading is different for the token project and the market maker, right? You don't have the same challenges. So in a way, it's much easier for a token project to become their own market maker because they're not limited by the let's say the constraints of the definition of what it means to trade profitably. Whereas a third party who doesn't control the token supply will have a very different metric by which to measure their own success. So yeah, I mean, if you understand how markets operate, I think that the app is pretty self-explanatory. But yeah, failing that, Jen, Glenn, and I are always open to talk to people who have an interest in creating an on-chain market for their token.
Yeah, like
Thanks,
I said,
Mark. Oh, go ahead.
Yeah, I was just gonna say, I'm always here to help other projects, right? We've worked closely with, for example, Governor on Ethereum mainnet, right? They did a strategy airdrop, which is quite cool, right, on Carbon DeFi. I think this is like the first
Yeah.
we've seen, right? We've worked with other projects, for example, on say Synax, actually putting a proposal in our governance for some of the things that
That's
they're doing,
right.
right? This is like quite cool to see. I would say on Koti, there's something called Pengo, right? They've done a lot of
It's
interesting
so
things.
cool what Pango is doing. They're doing so much on Carbon DeFi right now, making use of the art fast
Absolutely.
lane and everything. Yeah.
Yeah, they have cross pair set up. They've done airdrops as well. So they've done a lot of different things, and what they're doing with Carbon DeFi is also quite amazing, right? So we talk to all these projects. Obviously, you're happy to talk to other projects as well. You're trying to achieve something on chain. We're always available here to help you out.
Yeah, I shared both of your X's, like your handles up there. Mine is up here as well. The Telegram, Carbon DeFi XYZ. So if anybody has any questions, you want to stop in there, please do. Thank you guys so much for joining me again. Glenn, keep putting out those posts because I love reading them, and I don't get so much time to catch up on some of the drama and things happening in the space. So I feel like you're always on top of it and always offering some sort of a solution to something someone might be facing out there. So yeah, keep at that for sure. Thank you guys again. Thank you to all of the viewers as well. And hopefully we'll be hearing from some of you. Thank you guys.
Thank you.
Mm-hmm.